$33 trillion. That's how much debt the US is in. As government spending, interest rates, and fears of a recession continue to climb, I noticed why the US won't pay down its debt, and why it doesn't even care. But first, to understand why, we need to understand what exactly is national debt. In 2023, the US government is expected to spend $6.3 trillion. Social Security, Medicare, new fighter jets. Of that $6.3 trillion, $4.8 trillion was financed by federal revenues. Payroll taxes, income taxes, state taxes, corporate taxes, excise taxes, sales taxes. But what about the other $1.5 trillion? In finance, they call this a budget deficit. Basically, it's when the amount of money going out is more than the money coming in. If you walk into the Apple store with $100 and decide to buy a $1,000 iPhone, the employee will probably say, no, you have a budget deficit of $900. Okay, maybe not exactly those words. The only way for you to afford that phone is to take on debt. After a card swipe, a click, and a tap, you stroll out with a new phone and $900 in credit card debt. When it comes to the US government, they tend to do something similar, except you, companies, and foreign governments are the credit cards. If the US government needs to borrow money, they'll sell you this thing called the government bond. Basically, it's a piece of paper with the words IOU on it, along with the promise that they'll pay you back with interest. The problem is, the US government had to do this for every single year for the past 20 years. In 2022, they had a $1.4 trillion deficit. In 2021, $2.8 trillion. In 2020, $3.1 trillion. Over time, this led to a bunch of IOU papers and $33 trillion in national debt. But what if I told you that the total amount of debt doesn't actually really matter? What's more important is how much debt is owed in relation to something else. In economics, they call this debt to GDP ratio. Basically, it's a metric comparing how much debt a country owes relative to the size of its national economy. Walking into a bank and asking to borrow $1 million might be weird if you only have $50 to your name. They might call security and have you escorted out. But it's a completely different story if you have a $500 million net worth. A good rule of thumb for governments is to keep national debt at a ratio below 100% of GDP. Anything over tends to be bad news. In 2011, Greece had a debt to GDP ratio of 180%. Shortly after, it declared bankruptcy. The problem is, the current US debt to GDP ratio is at 120%, and things are getting bad. But something that isn't bad is Moomoo that's offering up to 15 free stocks. If you open and deposit $1,000, you get 15 free stocks valued up to $2,000 each. And despite the funny name, they are a registered broker-dealer with the SEC and is a member of SIPC, meaning you're insured up to $500,000. Get your free stocks? Link below. So why doesn't the US care about paying down this debt? When it comes to household finances, debt is generally viewed as taboo. Over time, debt can lead to bigger financial problems if it's not taken care of. That $100 grocery store run could turn into $400. Charlie's $500 PS5 present can now cost you $2,000. But government finances is a completely different story. They're not bound by the traditional way you and I understand debt and personal finance. When it comes to the US government, national debt doesn't really matter. Economist Warren Mosler knows a thing or two about this topic. His research into national debt started while he worked on Wall Street in the 1990s. Specifically, he caught something that everyone else overlooked that led him to profiting over $100 million. In the 1990s, Italy was in a very shaky situation. They had borrowed a lot of money, their economy was questionable, and investors were concerned. Will Italy pay us back? What if they run out of money? Can Italy default? Despite every investor being scared that Italy might not pay back their bonds, Mosler bought even more Italian bonds. He became the largest holder of Italian bonds outside of Italy, and he did this because of one simple reason. Most people's experience with personal finance follows this path. Get paid, use that money. If you need more money, borrow. Naturally, we think governments do something similar. Governments collect taxes for money, they spend that money. If they want to spend more, they borrow by selling government bonds. In this understanding, bankruptcy and defaulting on debt is a very real possibility. But governments follow a different set of rules where household finances don't apply. Economists call this modern monetary theory. Basically, it's the idea that countries that spend, tax, and borrow in a currency that they control can never go bankrupt. When it came to Italy, its national debt was denominated in their currency, lira, and Italy was the only producer of lira. As a result, Italy technically couldn't fail to pay its debt because they could always print more lira. It would be as if a laser tag game ran out of points to give to its players. Shortly after, Mosler was right. His Italian bonds never defaulted, and he profited $100 million. And if you want to stay informed with financial news, sign up for Daily Market Briefs, my free 3-minute daily newsletter, link below. This finding, along with many other follow-up studies to back it, have come to the conclusion that countries who issue their own currency, like the US, Japan, and Canada, play by a different set of rules. When it came to Greece declaring bankruptcy, it happened because they abandoned their own currency, the drachma, and switched to euros. Greece was spending and borrowing with the currency they couldn't issue or control. They were forced to budget like a household, and government spending was constrained by deficits and debt because they owed a debt to the European Union. Unlike Greece, the US does control our own currency. When the US government wants to spend money, Congress authorizes it, then the Federal Reserve credits the appropriate accounts. Studies have found that for the Federal Reserve, spending money is as simple as typing a few keys on a keyboard. This is former Federal Reserve Chair Ben Bernanke on 60 Minutes.
Is that tax money that the Fed is spending?
It's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
In layman's term, the government spends and lends money simply by changing a few numbers on a computer keyboard. As a result, the US technically doesn't need to raise revenue by collecting taxes or borrow money through government bonds. So naturally, you might ask, what's the point of taxes and bonds then? This is millions of dollars of shredded money in Washington, D.C. You can actually buy this. It's what happens if you go to the IRS and pay your taxes in actual cash. You'd hand over your hard-earned money, the IRS agent gives you a receipt, then throws your cash into a shredder. The government doesn't need to reuse your money, instead it can just create new money. It's like a ticket to a Taylor Swift concert. You enter the venue, hand your ticket to an attendant, and they destroy it. The venue doesn't need your ticket to offer for the next show, instead it simply creates a new ticket. When it comes to collecting taxes for the government, it's not about using the tax revenue to pay for things. It's more about using it as a way to destroy existing money. When the government taxes, it simply subtracts money from everyone's account. But why? After some research, I discovered two reasons. Firstly, requiring taxes creates demand for the US dollar. In 1971, the dollar was taken off the gold standard, meaning it was no longer backed by gold. As a result, the dollar became intrinsically worthless. However, since the government requires people to pay taxes in US dollars, artificial demand for the dollar is created. That's why you can't pay your taxes in euros, gold, or magic lamps. Next, taxes are also used as a tool to implement policy objectives and encourage or discourage certain behaviors. You're less likely to smoke cigarettes if it's heavily taxed. You're less likely to drive into the city if tolls are $50 one way. You're less likely to drink alcohol if it costs an extra $60 a bottle. Likewise, if the US government wants more people to switch to renewable energy, they can offer tax incentives on electric vehicles. But what about bonds? What's the point of them if the government technically doesn't need to borrow any money? Economist Mitchell and his colleagues know a thing or two about this. In his textbook, Macroeconomics, Mitchell says the point of selling government bonds is to prevent interest rates from falling too low. It gets a bit complicated, but stick with me here. When the US government spends money, Social Security, stimulus checks, constructing buildings, that money is essentially added to private bank accounts. As a result, the amount of cash reserves in the banking system increases. When banks have an excess amount of cash, they will naturally need to find a way to use this money to make more money. As a result, banks will try to lend out this excess money, pushing down interest rates. In economics, this can be explained by the law of supply and demand. Basically, if there's an increase in the supply of money without a proportional increase in people's demand to borrow it, the cost to borrow that money is going to go down. The problem is, if interest rates become too low, people might borrow too much, buying a third Tesla, taking on a second mortgage, or buying 2 more iPhones to use as alarm clocks. All this risks economic instability. And the US government knows all about this. Just like Goldilocks, they need to find a perfect balance for interest rates. Not too high, not too low. If they want to raise interest rates, they'll sell government bonds to the private banks. Since these bonds offer pretty decent interest rates and are a much safer option than their alternative, private banks will happily give the excess money to the US government. With less excess reserve, there's less money to lend out, pushing interest rates higher. Mitchell says these activities are coordinated with the Treasury, which will usually issue new bonds more or less in step with its deficit spending. This is because the central bank would run out of bonds to sell to drain the excess reserves created by deficit spending. While the US government could technically pay all of its $33 trillion of national debt tomorrow, it would never do that because of one reason. Under modern monetary theory, the US has very few financial constraints, but there is one guardrail that the government never wants to cross. But is crossing this guardrail really that bad? And is it worth facing the 2 significant issues that stem from having $33 trillion in national debt? Firstly, there's credibility to think about. Lending money is based on trust. In finance, they determine credibility with a credit score. Basically, it's a number that tells you how likely someone is to return your money. Yes, John, I'm talking to you. This is a reminder to Venmo me back for that dinner. Countries are measured with a different type of credit rating. Places like Germany, Sweden, and Singapore have the highest credit rating of AAA, while countries like Sri Lanka, Zambia, and Belarus have the worst, SD or selective default. Naturally, the lower your credit rating, the less others trust you. The problem is, the US was recently downgraded from AAA to AA+ thanks to rising national debt, lack of a plan to address it, and a volatile political environment. Next, this number will only get bigger, faster. Naturally, when you borrow money, you owe interest on it. In 2022, net interest payments on national debt reached the highest dollar amount ever recorded in history at $475 billion. But this number is nothing compared to the expected $663 billion in 2023 or $745 billion in 2024. Over time, net interest payments alone will be more than our annual budget deficit today. But neither of these issues worry the US more than crossing this one guardrail. Even though it can, the US will not pay off all its debt tomorrow in fear of hyperinflation. But what if I said the US not caring about its debt should be the least surprising thing? What most people don't realize is something weird is happening to your job. Today, employers are firing people without actually firing people. Click here to discover what's happening before it's too late.